Time for a quick market review where we're going to figure out what's happening with these markets. Are we going to head higher or lower? That's always the question, right? And as usual, our research is coming from Macro Ops, our global macro research and consulting firm. Now, if you remember in the previous videos, we were talking about the possibility that market internals were so bad that they are good. And that goes back to what we were discussing about breadth in the market. We were saying that prices kept heading higher, but breadth was lagging. So one thesis was that this meant that the market would turn around, because you want to see breadth and price move together. You want to see all the stocks moving together, and that's breadth. Otherwise, if it's just a few stocks pulling the whole market up alone, that's not a very healthy market. That means the internals are weak. But the other way to look at it was that the internals were so bad that they were actually going to follow price, meaning that all the stocks that were lagging behind were just taking a little longer to follow the stocks that were leading. And that's what we got to do here, right? Look at different scenarios and see which one plays out. It's all about probabilities. We're not trying to make predictions here. And so far, it looks like this second scenario is playing out. So as you can see, like right here in the Russell, the breadth is turning up. Now, this is an important concept. A test survived means a trend strengthened. So George Soros, if you know him, the legendary investor, would often talk about how when a trend is tested and survives, it becomes strengthened in the process. So in our case that we're talking about right here, breadth was weak, the market did not fall. So the fact that it didn't fall means that it's actually stronger than we thought. So there are narrative and positioning reasons for this. One being that those people that were betting against the trend, so like all the cash that was on the sidelines that wasn't bullish, they're forced to either rapidly reposition or chase the action higher. And this rapidly repositioning, this is what you see in short squeezes too. So when people are short and then, the stock takes off, what do they got to do? They got to cover their shorts, and that pushes the price higher even faster. So either way, whether they're covering their shorts or chasing the action higher, they're providing buying pressure to the tested trend, which actually makes it stronger. So in the case of people who are trying to short and have to cover, it's almost like a bear trap, right? They thought the market was going to fall, but it didn't, and then it rebounds even harder and then goes off on a bull run. So in our scenario right now, it looks like we got a sharp recovery in breadth that we've seen over the last few days. So the trend has been tested, survived, and it's strengthened as a result. So really, our breadth indicators should turn positive for all the major US indices over the next few trading days. And a rebound in breadth is a great signal that short-term momentum is picking up to the upside. Now, we will want to see credit follow through in the coming weeks. And remember, credit is really important. It kind of leads the equity markets. And right now, they are diverging once again. Price up, credit down. Now, if credit does not follow, it'll suggest that this is likely just an acceleration of the final stages of the longer-term buy climax, which we've talked about before as well. But remember, even with this buy climax, yeah, we might pop higher and then fall, and we might get a correction for 2 to 3 months, but long-term, we're still bullish. So when we're talking about all this stuff, you got to remember that we're speaking in different time frames. And your strategy is going to kind of determine how you play it. So one thing that does have us more long-term bullish is the fact that much of the world has been trading sideways to slightly down since the start of the year. So you can see that right here in these charts. These are various global markets. So we've seen roughly 8 months of consolidation after a significant run-up from the COVID bear market lows. And markets don't usually top like this. Normally you get massive action to the upside and then you fall over. But because of this sideways action, a lot of the weak positioning has been worked off. And if these markets start breaking higher, and when we're talking globally, we're talking about the Nikkei, which is, the Japanese market, the Dow transports. If they follow the recent move up in semis, which is semiconductors, which you also remember we've been tracking in previous videos, then it'll suggest that we're at the start of a larger bull market thrust. So again, really trying to measure the probabilities here. Now, going back into the buy climax theory, you can see that July here marked the 6th consecutive monthly bull bar for the SPX. You see 1, 2, 3, 4, 5, 6. And this is very rare. We talked about this last week. But we're now at the apex of our 16-month rising wedge and the third up leg in a buy climax, meaning this trend is getting old. And by the way, if you remember, this 6 bull bars is the longest streak in 10 years. Now, this means that the long-term bull trend is strong, and also that odds are high we see a multi-month pullback. So we get a pullback and consolidation that would begin in the next few months. But before that happens, we'll likely see a pitch over the buy climax area before we see that pullback. So this red line right here. We see a pitch over the trend, which will be a bull trap, which will be followed by 1 to 3 months of reversal and consolidation. But still, remember, long-term bullish. So this is more medium-term analysis. So 6 consecutive monthly bull bars is a rare thing, and it's a sign of strong structural demand pressure, which is why, even though we might see a multi-month pullback soon, that dip is going to get bought. So we could see a 10 to 20% correction, and it's going to get bought as bulls still clearly control this market. And it doesn't pay to try and fade this type of momentum. So basically, when this correction comes, you don't want to go heavy short, because you will get blown out. But now that doesn't mean you shouldn't manage your risk, because yeah, this looks like the highest probability scenario, but it doesn't always work like that. A lot of times the thing you're not expecting happens, and that's where your risk control comes in and saves you. So don't feel stupid if you sell during a correction. position, as long as you're following your strategy, and then the market takes off afterwards. Good risk control is always going to pay you out in the long term. But again, depends on your strategy, whether you would be buying or selling during that dip. So our proprietary backtesting method shows there have been 10 similar past occurrences of this happening, and the average returns are strongly positive on a go-forward basis. So this is average returns for the S&P 500 after 6 months of bull bars. So again, probabilities are good. Now, as we were talking about before, there are some problems in the credit market. Credit spreads have widened further as all this has been happening. And remember, credit sits above equities in the hierarchy of markets, meaning it really leads equities. You can see right here when these red lines spike above this horizontal red line, that's where you get the big dips in the market. So the fact that it's spiking now is kind of a bearish sign, but this is common in the final stages of the buy climax. So this pitch above and fall might happen sooner rather than later. So this is definitely something to keep an eye on. And by the way, if you don't have a strategy yet to trade this market, or you want to improve your strategy, make sure you check out our free training. I'll put a link to it in this video and down below in the description and comments. It's the same strategy I use and all our Fallible members use, and we're all very happy with it. Makes risk management and trying to deal with these probabilities in the markets way easier. So click the link in this video and I will see you in that training.